Hello and welcome. Today's video is going to cover an introduction to fund principles. The learning objectives of this training are gaining an understanding of funds and their relationship to governmental accounting and reporting, and being able to determine the different categories and types of funds. To follow along in the BARS manual, please go to sao.wa.gov and click the BARS and Annual Filing menu. Select the appropriate manual, either GAAP or cash, depending on your government's accounting basis, as shown in the orange box. Once in the manual, on the left-hand side menu, click the Accounting section, then Accounting Principles and Internal Control. The first selection in this submenu is Fund Types and Accounting Principles. This is the section that we will be covering today. So let's start with learning exactly what a fund is. Funds are a set of accounts that record cash and other financial sources as well as financial activity. Each fund should be self-balancing and should be segregated for the purpose of carrying on specific activities. What do these two things mean? Self-balancing means that transactions innately balance, or simply put, debits are equal to credits and each fund follows the basic rules of accounting, such as disbursements are reductions and revenues are increases. Segregated for specific activities means that funds are created for specific purposes and are used to monitor specific activities. As an important note, RCW, which is Washington State law, 4309-210 considers funds as a separate entity, and therefore one fund cannot benefit another. Why is a fund a separate entity? The technical definition of a fund is a fiscal and accounting entity with a self-balancing set of accounts recording cash and other financial resources, together with all related liabilities and residual equities are balances and changes therein, which are segregated for the purpose of carrying on specific activities in accordance with special regulations, restrictions, or limitations. In RCW 4309-210 states that each entity should be accounted for separately and all services rendered should be for the full amount of the service. What does all this mean for our accounting systems? This means that a governmental accounting system should at least be able to demonstrate fairly and with full disclosure the funds and activities of the government in conformity with their accounting principles, and be able to determine and demonstrate compliance with finance-related legal and contractual provisions. Let's look at what funds look like on financial statements. In this GAAP statement, each column is a fund. Therefore, we are showing three funds: water, wastewater, and stormwater. Now let's look at cash basis financial statements. Cash basis governments have a similar column format on the C4 that is printed out from the filing system. In this example, there's three funds: the current expense, E911, and IHCS. The first column is not a fund, but a total of all funds reported by the government on the C4. This first column is unique to cash basis financial statements. Now that we know what funds are, why do we need funds? Since government resources are closely watched by the public and your citizens are interested in how you are spending public dollars, We need a way to track these for each of our activities to be transparent to our citizens. Funds help us show the public what we are spending their money on and how we are supporting programs and functions of the government that are important to the citizens. For example, if citizens want to know why the dump rates at the local landfill were increased, it helps if you can show that the landfill was losing money with the old rates. If we didn't use funds, we couldn't show that there was a good reason for the increase and what the increase would be covering. For another example, if we did not separate the activities out by funds, we might not know that we are using money set aside for the police force to save the landfill. It would be hard to explain to citizens why the police department was having financial issues without the separation into funds. The use of funds allows us to be accountable to our citizens and help management address problems. An easy way to remember this is that governments are in the business of being accountable, not profitable. What happens if we don't use funds? Imagine this apartment is our city. We view it just as one big entity. So all the revenues and expenses for all activities are commingled. But what happens if that city starts to lose money? With no funds, all we see is that the government had more expenses than revenues. They didn't make enough money to cover all of their expenses. What do we do in this situation? Well, let's say the government decides to raise their water rates to make up for the deficiency. That might solve their overall cash flow problem. But how do we know if that's the right solution? Let's look at it by fund instead. We can view the government as a neighborhood. Each house is essential to the neighborhood and makes up the overall community. Each one is important, and each one accounts for their revenues and expenses separately. Well, now that we account for the activity in different funds, we can look at each individual activity and we can see that it's actually the Parks Department losing money. Maybe the Parks Department was building a new play structure, so their expenses were higher than normal. Or maybe their parks revenue declined because they had to shut down their rental facilities for a while. Either way, because of fund accounting, we can see where the problem is and address it directly. We now know not to just raise water rates. That won't solve the park fund's deficit. Fund accounting can also help your government justify rate increases. For example, let's say that the Parks Fund is really for a community pool, and this was just a normal operating year for the parks. No big projects or unusual events to slow down pool visitors. Then you could look at this and see that you need to increase admission prices for the pool. And you'd be able to show your citizens that you are not collecting enough in admissions to continue operating the pool unless you increase rates. We know what a fund is and why we use funds. Now let's discuss the different categories and types of funds. There are 3 categories of funds and 11 different types of funds in those categories. We will go into greater detail for each type of fund and each category, but this is a general overview of how funds are related. A question we get often is, what is the appropriate number of funds for a government? Remember, not every government will use every category of fund or every type of fund. Government should only establish and maintain a minimum number of funds that is consistent with their legal and operating requirements. Unnecessary funds create inflexibility, complexity, and inefficient financial administration. Your governing body and your citizens do not want to wade through 100 different funds just to find the information they need to make decisions. Causing this delay because information is hard to find would not be transparent. We will go into detail about the 11 fund types a little later. For now, we'll focus on the 3 fund categories. The fund categories are governmental, proprietary, and fiduciary. If you are a special purpose district, all of your activities are generally reported in either a governmental fund or a proprietary fund. Only general purpose governments, which are cities, counties, and towns, generally use all 3 fund categories. How does your government's activities relate to these 3 categories? Let's find out, starting with governmental funds. The first category, and the one used most often, is governmental funds. Governmental funds are used to record governmental activities. Governmental activities are activities that are primarily supported by taxes, grants, and other non-exchange revenues, like contributions. Some examples of governmental activities are fire service, police service, jails, parks, and health programs. Why is it important to have governmental activities? Well, let's use firefighting as an example. If the fire department was ran like a business and each person was billed for protection every month, what would happen if you couldn't pay the bill or were late? Would the department not respond if your house caught fire? Who would be charged for general protection from wildfires? We have governmental funds because programs like firefighting are essential programs that governments provide that are not tied to one individual's ability to pay for that function. An item of note is that governmental funds have a feature that is not present in other funds, and that is expenditures are controlled by legally adopted budgets that are cash-oriented and short-term in nature. Let's move on to proprietary funds. Since governmental funds are used for general activities, which are supported by taxes, what happens if you run a program that is similar to a private business? That's where you use proprietary funds. These funds are used for business-type activities, which are activities that primarily receive support from fees and charges. For example, utilities or a golf course. A lot of cities and counties own their own golf course. These courses are business-like because we shouldn't technically be using taxes from our citizens to support the golf course. Since these are not for the general benefit of the public, and citizens may feel like there are more important uses for their taxes. So how do we run a golf course and still be in compliance with laws and citizens' expectations? We generally support the golf course with fees and charges for service, such as membership fees, green fees, and any pro shop purchases. To summarize, proprietary funds are used to present business-type activities, which are supported from charges for providing goods or services, similar to a private business. For the category portion of proprietary funds, it does not matter who is purchasing these goods or services. Generally, you would include activities such as utilities, solid waste, airports, etc. You would also include centralized services such as janitorial, IT, motor pool, and equipment rental. On to our last category of funds, fiduciary funds. We know that our general activities are in governmental funds and our business activities are in proprietary funds. So what do we do when we are just holding money for others and cannot use the money for our own purpose? We use fiduciary funds. Holding money for others without being able to use the money for your government's purpose is the basic definition of fiduciary activities. We will go into more detail on the criteria for activities to be reported in the fiduciary funds later. An example most of us know are state pension programs, such as PERS and TERS. We contribute money to the Department of Retirement Services and they administer the pension plans. DRS cannot use this money for their own purposes, such as renovating their office space, upgrading computers, etc., because this money is not their revenue. Pension money is the employee's money and therefore should be accounted for in the fiduciary funds. Now that we know about fund categories, let's talk about how these categories relate to government types. Cities, towns, and counties might use all three fund categories, depending on what services the government provides. Other government types typically only use either governmental funds or proprietary funds, depending on the purpose of the government and how they receive their support. Any government type can use fiduciary funds, but generally we only see fiduciary used by cities, towns, and counties due to the collection of monies for other governments. Now that we know what the fund categories are, let's talk about the individual fund types. We will start with the 5 governmental fund types. First up is the general fund. One of the most important things to remember about the general fund is that you can only report one on your financial statements. Some governments have multiple general funds in their accounting software for more detailed internal tracking. However, for reporting externally, you must combine or roll up all of those general funds into one fund on your financial statements. Most of the resources receipted into the general fund are unrestricted and can be used for any governmental purpose, like general property taxes. However, that doesn't mean you can't have resources in the general fund that are restricted, committed, or assigned. It's just that oftentimes those resources are reported in other funds. The general fund reports all resources that are not accounted for in one of the other funds. As we'll talk about, the other funds have specific criteria that needs to be met to use them, but the general fund does not. It's kind of the catch-all. If something can't be reported in another fund type, it goes into the general fund. Just a reminder, the general fund is a governmental fund, so you can only use the general fund if your government has governmental activity. If you are a government with only proprietary activities, such as a water district, then this does not apply to you. Next up is special revenue funds. Special revenue funds account for specific revenues that are restricted or committed to be used for specific purposes. The big caveat here, though, is that specific purpose cannot be for debt service or capital projects because those go into the other fund types. A couple examples of special revenue funds that we see at governments are affordable housing resources, hotel motel tax, ambulance, etc. There are two criteria that must be met to use a special revenue fund. The expenditure must be for a specific purpose. That means it either has to be restricted or be committed. Restricted means some external party said you can only use this money for this specific thing. An example of that is lodging tax. You are allowed to collect lodging tax by state law, but that law also says you have to spend the revenues on tourism. The law is an external force and it is restricting what you are allowed to spend that lodging tax money on. Committed means there is an internal restraint on the money. For it to be committed, the government's highest level of decision-making authority has to take formal action. That would be like the Board of Commissioners, City Council, Board of Directors, etc., passing a resolution or ordinance. The second criteria is that the specific revenue must be a substantial portion of the inflows in that special revenue fund. Substantial portion means 20% or more. Special revenue funds can be subsidized with unrestricted revenues that come from the general fund or other sources. The rule is only that a substantial portion of the revenue must be restricted or committed, not 100%. So how do you calculate whether a substantial portion is restricted or committed? Well, we have an equation for that. You simply add the restricted and committed revenues, then divide that amount by the total inflows into the fund. Total inflows includes those restricted and committed resources, plus all other resources, including other increases like transfers in. You are aiming for at least 20% here. We recommend that you perform this calculation annually to determine if your special revenue funds continue to meet this requirement. Let's walk through an example together. In this example, we have a city that is reporting a special revenue fund for their tourism activity, and we want to determine whether a substantial portion of the inflows are restricted or committed. We have the following information. Beginning balance is $100,000. Hotel motel tax received, $20,000. This is restricted by state law to be used for tourism. Property tax received, $5,000. This property tax has been committed by the governing body. Transfer in, $75,000. The top part of our equation is for the restricted and committed funds. So what is the total restricted and committed funds? We are going to add together the $20,000 in restricted hotel motel tax and the $5,000 in committed property tax. That gives us $25,000 in restricted and committed resources. The bottom part of the equation is for all inflows. So what are the total inflows? We know that we already have $25,000 in restricted and committed inflows, but we also need to add in the transfer in of $75,000. That gives us $100,000 total inflows. So that means 25% of the total inflows are restricted or committed. Does that meet the substantial portion of inflows criteria? That is more than 20%, so this fund can be reported as a special revenue fund. Now, what if there was less than 20% in restricted or committed resources? Then the tourism activity could just be rolled up into the general fund for financial reporting. Next up is debt service funds. Debt service funds are used to collect resources that are restricted, committed, or assigned to pay back long-term debt. Notice I said that it is for repaying debt. A common misconception is that bond or debt proceeds are reported in the debt service fund, but that is not true. The debt proceeds are going to be used for your construction project or big purchase. The debt proceeds are not going to be used to repay the debt itself. So the debt proceeds need to be receipted into a different fund, like a capital project or the general fund. Most of the time, using this fund is optional. You could just report the debt repayment in the general fund. The one exception to that is if you are legally mandated to use a debt service fund. An example would be a bond issuance if the bond covenants require you to use a debt service fund. Even when you are not required to use a debt service fund, it is helpful to use it to show your debt repayments separately from other activity. Last thing I want to highlight about debt service funds is that it is only for governmental debt. Proprietary debt should be reported in the proprietary fund. So if your water fund issues debt to upgrade the water system, that debt is reported in the water's proprietary fund, not a debt service fund. Remember, a debt service fund is a governmental fund type, meaning only governmental type debt can be reported here. Next up for discussion is capital project funds. Capital project funds are for, as you could probably guess, capital outlays. Sometimes the use of this fund type is required by debt covenants, grants, or laws. For example, if you issue debt, one of the requirements might be to account for the capital project in a separate fund to show that you are using the bond proceeds for allowable expenditures. Most of the time, though, it's not required to use a capital project fund. We still recommend the use of capital projects for a few important reasons. It separates out long-term capital projects and helps someone looking at your financial statements understand the capital activities more clearly. It avoids distorting your general fund expenditure trends. If you accounted for a big project in the general fund, then during the years that project is going on, the general fund expenditures will be way higher than normal. It helps properly distinguish capital outlays from operating expenditures. Last thing I want to highlight about capital projects funds is that it is only for governmental capital outlay. Proprietary capital projects should be reported in the proprietary fund. Now we are going to walk through an exercise together to demonstrate how the debt service and capital project funds are used. Here are the facts. The government issues a new bond for $50 million to construct general government buildings. Government levies a new tax to pay for the bond's debt service. The tax revenue in year one was $2 million. The capital expenditures in year one were $24 million. The first debt payment in year one was $1,800,000. Assume the government plans to use both a capital project fund and debt service fund for this project. We are going to walk through filling out this very simplified governmental revenue and expenditure statement. Which fund would the bond proceeds be reported in? Capital project. It is specifically meant for a new capital asset, the building. You put the revenue in the fund that will spend the money. Which fund would the tax revenue be reported in? Debt service. It is specifically meant to repay debt. You put the revenue in the fund that will spend the money. Which fund would the capital expenditures be reported in? Capital project. Which fund would the debt payments be reported in? Debt service. The increase or decrease in cash and investments is revenues minus expenditures as shown on the screen. Last up is permanent funds. Permanent funds are used to account and report resources that are restricted to the extent that only earnings and not principal may be used for the government's own programs. What do I mean by that? That means the principal amount cannot be spent. Instead, you invest that amount and are earning interest. It is the interest earnings that you are spending to support your government programs. Typically, with permanent funds, there is some type of written contract or agreement from the contributor or donor that outlines the requirements to meet the fund definition. Some common examples we see include cemetery maintenance, endowments, or park endowments. Let's talk about the accounting and permanent funds. In the permanent fund, if the interest revenue is spent on an ongoing or existing program the government already offers, then you should be reporting the principal amount, which is likely the original donation amount, interest revenue, and transfers out. For example, let's pretend a local citizen donates $100,000 to the city and states the $100,000 cannot be spent but should be invested. And the interest earned must be used to maintain the local cemetery. This would meet the requirements for using a permanent fund. The principal amount of $100,000 and the interest revenue would be reported in that permanent fund. Then the interest revenue would be transferred out of the permanent fund and into the general fund. The cemetery maintenance expenditures would also be reported in the general fund. The cemetery expenditures should not be reported in the permanent fund. On the other hand, if you receive a donation where the interest revenue can only be spent on an activity or program the government doesn't already have, then the operational expenditures may be accounted for in the permanent fund. For example, let's pretend a local citizen donates $100,000 to the city along with a piece of historical artwork and states that the $100,000 cannot be spent but should be invested. And the interest earned must be used to maintain the artwork. The government does not have any programs for maintaining historical art. This would meet the requirements for using a permanent fund. The principal amount of $100,000 and the interest revenue would be reported in that permanent fund. The expenditures related to maintaining the artwork, such as repair or cleaning, may be accounted for in the permanent fund. That's it for governmental funds. We are now going to talk about proprietary funds. Here we have two fund types, enterprise funds and internal service funds. An easy way to remember the difference between these is that enterprise funds start with an E and serves external users, which also starts with an E. For internal service funds, it starts with an I and serves internal users. Let's discuss enterprise funds first. Enterprise funds are used when the main source of revenues is charges for goods or services to external users. Enterprise funds are required to be used if any of the following items are true. If you have debt that is backed solely by the fees or charges of the fund. What does that mean? If you issue debt and the debt issuance paperwork says that the debt repayments can only come from the charges for services for a specific activity, that activity must be reported in a proprietary fund. Example of this is if you run a sewer and issue debt and the debt covenants say that you will only repay the debt using the sewer revenues, but you will not use any of your other revenue sources like property taxes, then you would be required to report that sewer activity in an enterprise fund. If there's some legal requirements that you must recover costs through charges, or if you even have an internal policy that says you will recover the full cost of the program through user charges. Generally, if an activity is operating similar to how a private business would run, it should be in an enterprise fund. Common examples of the activities we see in this fund type are things like water, sewer, ports, colleges, hospitals, airports, and sometimes golf courses. Remember earlier when we were talking about governmental funds and how they have separate funds for debt and capital activities? Well, this is different for enterprise funds. All of the related activity is reported in the one enterprise fund. For example, if you have a water fund to provide water to your citizens, if you issue debt, that gets reported in your water fund. If you have a capital project to upgrade the water system, that gets reported in the one water fund. Now, if you choose to report the water debt and the water capital project in other funds, those would be called managerial funds that will ultimately get rolled up into the one main water fund for financial statement reporting. Now let's discuss internal service funds. Internal service funds are similar to enterprise funds because they are also funded by charges for services. However, the main difference is that this time you are charging internal users, which would be other funds or departments within your government. All of the activity related to the internal service fund should be reported in the one fund. There's no separate funds for debt or capital activity like we have for governmental funds. The use of an internal service fund is completely optional for financial reporting. You don't have to use an internal service fund. Common examples of internal service funds are for information technology, equipment rental and replacement, otherwise known as ER&R, even self-insurance activities like health and welfare or property and liability, or even unemployment self-insurance. There are a couple rules for using this type of fund. The first is that your own government must be the main user. Although it is okay to have some outside users, for example, let's say a county runs a mechanical shop that services all of the county vehicles. Every now and then, one of the cities pays for you to service one of their vehicles. That is okay. You can report that activity of servicing the city vehicle in your internal service fund. However, It is important that the main source of revenue continues to be from other funds or departments within your government. If you are getting more revenue from users outside of your government, then it should be an enterprise fund instead. The other rule is that the internal service fund must operate to break even or recover costs over time. Over time means over a rolling period of 3 to 5 years. You don't have to break even exactly every single year, but you do want to be aware of charging enough to cover your costs while not overcharging other departments. Remember that our CW that says one fund cannot benefit another. So over time, you want to be covering costs but not charging too much. Let's move on to the types of fiduciary funds. We have spoken about fiduciary activities before, but let's go into more detail. There are 3 steps to determine if a government has fiduciary activity. Step 1. The resources are controlled by the government. For example, if the government is holding the money in their bank account or if their name is on the bank account. Step 2. The resources are not the government's own revenue or transactions. For example, a county collecting the taxes for their special purpose districts. The tax money 100% belongs to the special purpose district and is not the county's own revenue. Step 3. There are multiple possibilities here. Only one of these 3 bullet points must be true. Administered through a trust that the government is not a beneficiary of, dedicated to providing benefits, legally protected from creditors, or benefit other individuals and the entity doesn't have administrative involvement in the resource and is not providing a service to the individual, or benefit other government or businesses for which the collecting government doesn't provide a service to that government or business in which the funds have been collected for. For more specific criteria in relation to fiduciary funds, please see BARS section 3.1.1 Fund Types and Accounting Principles. Our first fiduciary fund type is investment trust fund. Investment trust funds are only used if you sponsor your own investment pool or hold individual investments for others. This is used to only report the external portion of an investment pool that are in a trust or similar arrangement. In Washington, we would only expect counties to sponsor an external investment pool since they are mandated by state law to invest the junior taxing district's money until needed. Investment trust funds are used to report only the external portion of an investment pool. That means the portion of the money that does not belong to the government itself. For example, oftentimes counties will pool together money from several junior taxing districts and their own county funds and invest all the money together. Let's say the county receives $150,000 from City A, $30,000 from City B, and then has $15,000 from their general fund that is ready for investing. The county can take all $195,000 and invest it at the same time. However, only the $150,000 and $30,000 from the cities will be reported in the investment trust fund. The $15,000 from the general fund will be reported in the county's governmental funds in the general fund. Our next fiduciary fund type is the pension and other employee benefit trust fund. These funds are only used if you have your own retirement plan or other post-employment benefit plan, such as pre-LEF 1 pension and OPEB plans. Do not report any of the DRS plans in your pension trust funds, since these are not your government's plans. These plans must meet the requirements of a qualifying trust or similar agreement. Pay-as-you-go plans do not qualify. Different plans cannot be commingled, so if you have a pre-LEF trust that includes both pension and OPEB monies, then you could not use the pension OPEB trust fund category. Instead, they would be reported as governmental funds. If you are acting as an administrator for someone else's pension or OPEB plan, the plan still must meet the criteria above to be reported in a trust fund. Private purpose trust funds are our next fiduciary fund type. Private purpose trust funds are for when you have money held in an accounting trust or similar agreement, but it is not held for investing or for pension or OPEB plans, which have their own specific trust fund types. For example, a scholarship fund. On to our last type of fiduciary funds, and the only non-trusted fund, and also the only fund with a mandated sub-fund, custodial funds. This is the catch-all for fiduciary monies that are not held in a trust. There is specific requirements that must be met to use this fund type, which can be found in the BAR's manuals in the Determining Fiduciary Activities to be reported in Custodial Funds section of the BAR's manuals. Some common examples of custodial activities are counties acting as a treasurer for special purpose districts, cities, towns, and counties operating courts and collecting funds for the state's administrative office of the courts, and collecting state-mandated taxes and fees, such as birth and death certificate fees, concealed pistol licenses, sales tax, etc. The last fund type we are going to talk about today is actually a sub-fund of the custodial fund type, and that is the external investment pool fund. This fund would only be used by counties since state law gives them the authority to sponsor an investment pool. I know we spoke about investment pools in the investment trust fund section, but that was for an investment pool in a trust or similar agreement. If the county's investment pool does not meet the requirements to be reported in an investment trust fund, then the investment pool would be reported here. This is the only fund that has a specific mandated number instead of a range. To report a custodial external investment pool fund, you must assign fund number 699 to that fund to record correctly in the online filing system. As we wrap up our training on fund principles, let's take a minute to review what we have learned during our time together. First, we learned what funds are and why we use them. The important part to remember here is that funds are self-balancing set of accounts and that they are segregated for the purpose of carrying on specific activities. We use funds because they allow us to be transparent to the public. They are able to look at a fund and know the revenue stream, activities, etc. We learned that there are 3 fund categories and 11 fund types. SAO does offer a multitude of trainings and resources on different accounting and BAR's manual topics. Let's quickly go over some of them. You can find our training page from the BAR's and annual filing dropdown. The training and workshops link is towards the bottom. That menu takes you to our training page. Here you can find any upcoming trainings and our recorded training. Every year we put together an annual BARS update training where we go over changes from the prior year to the current year. We record and post them here so you can access it as many times as you need. One of our newer trainings that I'd like to highlight is the overview of the updated annual filing system. We refreshed the system this year, and this training will walk you through the updates so you know what to expect when you are ready to file. If you have any further questions, please feel free to use the help desk. Thank you for joining me today for an introduction to fund principles.